I'm going to show you a super quick and easy financial statement crash course for an absolute beginner and how to make sure that the dividend payment is being covered. Now, this is by no means complete, and I am not an expert, but I am a passionate dividend investor that several of you have asked for this, so here it is. Now, if you don't want the challenge of looking for superb individual dividend growth companies, there is a bit of an easy button, and that easy button is called SCHD, which is an ETF, and all that you're doing is buying a little over 100 great dividend growth companies in one fell swoop. And if you stick around to the end of the video, I'll have a little bit more information on that for you. Now, before we get going, I want to let you know that fundamental analysis, which is what we're going to be doing, meaning looking at the financial statements, is a little bit different for REITs, banks, and utility companies because these types of businesses have financial structures that need specific measurements and methods to understand how well they're doing, like using things called AFFO for REITs and net interest margin for banks, which aren't really used for other companies. Now, as a dividend growth investor, there are three things I like to look for right away. I like to see a demand for the product or service through growing sales, also known as revenue. Companies with increasing cash flow, which is a reflection of their economic health. Unlike earnings per share or EPS, which can be manipulated. And of course, as a dividend growth investor, I like to see dividends that are growing. Now, if this is something that you wish to do and proceed with, I highly recommend the book Warren Buffett and the Interpretation of Financial Statements, which I will have an affiliate link to Amazon below, where I'll get kicked a few pennies my way at no additional cost to you. So, my fine dividend investing viewer friend, there are three financial statements where this information is found. The income statement, also known as the profit and loss statement, shows a company's revenue, expenses, and resulting profit or loss over a specific period of time. In a nutshell, it tells us how much money a company made and how much it spent. The balance sheet gives us a snapshot of a company's financial position at a specific point in time and shows the company's assets or things it owns, the liabilities, which are debts or obligations, and all it does is gives us a snapshot of what the company owns and what it owes on that date this was filed. And the cash flow statement shows the flow of cash into and out of a company during a specific period, usually every 90 days, and shows us the sources and uses of cash and helps us assess the company's ability to manage and generate cash. Now, there's many places to do this, and while I like sites like Seeking Alpha and Simply Safe Dividends, and I would recommend checking out a site called stockanalysis.com where you can do a whole lot for free. It's a really powerful site that I've stumbled across. And the cool thing, if you click on financials here, is you'll see that you get 10 years of data for free. And if you wanted to go back any further than that, then they want you to upgrade. But this is just a wonderful site to get that full 10-year picture, which we highly recommend looking at the overall trend for a full decade. Now, I logged out of Seeking Alpha so you can see this is what it would look like if it was completely and totally free. And I'm going to use a company I don't think gets enough love around here in the dividend growth community, is Nexstar Media. So you'll just type that into the keyword box and then you will click on financials and you'll see right here is the income statement, the balance sheet, and the cash flow. And like we said, you're only going to get 5 years going back to 2018 plus the trailing 12 months, which is what TTM is, trailing 12 months. Now, I know many purists like to see the oldest data on the left, but I'm a goofball, so I'm going to do the newest data on the left. The first one to usually look at is the income statement, and the way to think about this is it's just like a giant sieve, meaning that the sales, the revenue, the same thing at the top line is what's dumped into the funnel, and we're going to see what's left after certain things get peeled away. Now, the cool thing about Seeking Alpha is if you ever get lost on most of these, you can just hover over and they will tell you, like right there, the money that a company receives, especially from selling goods or services, it's the total revenue that they're bringing in. And it should go without saying, we hope to see the total revenues going up. So as we move from right to left, I know you want to see these numbers rising, which here for Nexstar Media they are. And next we have the cost of revenue, which is the cost of goods sold, also known as COGS, which we'd like to see this number actually be lower. But for most businesses, it's going to cost more money just through inflation and things like that. But we want to see it increasing at kind of the same pace. You don't want something erratic. But you can see here for the trailing 12 months, it was $2.25 billion for Nexstar Media. So when we subtract the cost of revenue from the total revenue, we get the gross profit. And the cool thing about Seeking Alpha is if you come here to view and you put as a percentage of revenue, it will change all the numbers to make these percentages of the revenue. We see that they had a gross profit of 61.49%, which is really high. And as a rule of thumb, a really good company has 40% or better, where we see Microsoft has a gross profit of 68.5%, but a company like Walgreens Boots Alliance, ticker WBA, is down there at 19.84%. So that tells us that they are in a bit of a highly competitive environment. So we've switched back to the absolute view, and then we come down to the next round of siphoning off cash, money coming into the business, which is the operating expenses and income, which are what it costs to run the day-to-day business in order to sell those goods and services. This would be an extremely long video if we went through things like selling general and administration, depreciation and amortization, and all these things you can learn on your own. But after we siphon these costs to run the business off, we come at the operating income, which is the profit from the core business activities. So you see how we had a gross profit of $3.23 billion, siphon off operating expenses, and now we're down. It's whittled away to $1.39 billion for Nexstar Media. And then we come down to earnings from continuing operations, which is going to show us what's left over after paying taxes and give us an idea of how profitable the company's core operations are, which we see Nexstar Media has $779 million. And then we come down to one of the more important numbers, which is net income. One little stop here I find interesting is minority interest. This is profit or loss from businesses that Nexstar Media or whoever you're looking at are invested in but own less than 100% of. So we see that they got $50.6 million of their minority interest. So that brings us to net income of $830.1 million, which is the money that they actually earned. This is the money that the business actually gets to keep. But one cool thing, we're going to go and switch it right back once again to percentage of revenue. And a rule of thumb is we'd like to see a business over 20% to show that they have some kind of competitive advantage. The higher this number, the better. But Nexstar Media, not too shabby at 15, almost 16%. Now nicely, Seeking Alpha also shows us the supplemental items. Now these are things that are not required, but they're like little bits of extra information that can help us better understand the business, where money may be going, how things are looking. But one thing I want to focus on is the shares outstanding. As investors, we would like to see the shares decreasing because that means there are less shares to spread the earnings out over, making the shares more valuable. As long as the company keeps increasing their earnings, then we as shareholders get a bigger percentage of that. But we want to look at, instead of the basic weighted average shares outstanding, meaning how many shares there are, we see right here 38.3 million. We want to look at something called the diluted weighted average shares outstanding, which is, it says in the little bubble box right there, it's essentially anything that could be converted in the future, meaning tomorrow or 20 years from now, any commitment that's out there of a share that could be converted into shares. So that is 39.1. I like looking at this number as a more accurate representation of what our potential share ownership could be or how many shares are outstanding. So for Nexstar Media, 39.1, remember, always look at, in my opinion, diluted weighted average shares outstanding. And we'll talk about this a little bit later, but the dividend per share, we would ideally like to see this increasing, which every year, going back 5 years for Nexstar Media, 6 years including the trailing 12 months, it indeed has been increasing. More on this $4.05 number a little bit later. So next we're going to click on the balance sheet, which remember shows us what a company owns and what a company owes on that specific day that this filing was made. Now we'll move through this one quickly. A lot of this is self-explanatory. Cash and cash equivalents is cash and things that can be converted to cash relatively quickly, I believe in less than 90 days. You have the accounts receivable, which is what's owed to a company but not yet paid for. Now the current assets obviously are going to be all the things that the company owns, and they have that broken out also into long-term assets, which we see they have net of $12.464 billion. And then you get the liabilities. Again, remember what the company owns and what it owes. These are all the things it owes, like accounts payable, which is the exact opposite of accounts receivable. This is what the company owes to vendors and suppliers and things. And then you get the current liabilities, which are things that are going to be used in less than a year or a business cycle, whatever is longer. Those are the current liabilities, something that's going to be used up pretty quickly, of which they have $864 million. Then we get into the long term, which is anything pretty much longer than a year. Long-term debt, that's always a very interesting one. Again, maturity is greater than 12 months. We'd ideally like to see this coming down, which for Nexstar it has, and you will get the total liabilities. This is the combination of the current and the long term is $9.81 billion for Nexstar Media. And now the fun part of this balance sheet here is we get to find out the stockholders' equity. That means what you would be entitled to as a shareholder, obviously spread out amongst all the shares outstanding. And it's simply if all the assets were sold to pay off all the liabilities, what would be left over, if anything? So for Nexstar Media, we see there would be $2.653 billion. And a fun thing, if we were to take this stockholders' equity and divide that by the 39.1 million shares outstanding, we can just scroll down to the bottom of the page and find something called book value per share, of which we see is $72.92 for Nexstar Media. And then lastly, we'll hop over to the cash flow statement, which remember is going to tell us if a company is bringing in more money than it's spending. Let's hope to God that they're doing that. And if you remember, the bottom line from our income statement, which was the net income, is now the top line in the cash flow statement. So we're going to further siphon off from that and see what the company's doing with that money of the net income. And it gets siphoned through 3 different filters in the cash flow statement. The first one is cash flow from operating activities, which again, we won't get into depreciation and amortization. We'll not get into all of these for you. Again, buy the book, Warren Buffett and the Interpretation of Financial Statements. They lay it out really nicely in there. But as we go down to the bottom of this, we get the cash from operations, which again was the cash from the day-to-day business functions, which for Nexstar Media is $1.378 billion. And then last, what the cash is flowing in and out of from the financing activities, which if you look, common dividends paid, there we go. That's what the business has to pay to us, the stockholders. Well, they don't have to, but the board elects to. And just all those different things for financing the business, which when we add them all together gives us the net change in cash. This is a number we'd like to see going up. It doesn't always, it's not an automatic negative for the business, but generally we'd like to see that number increasing in the net cash. And Seeking Alpha is so nice to also have supplemental items like they do for the other ones, which one of the things that I love, my favorite right here, is the free cash flow per share. There's 4 things you can do with free cash flow that I want you to always remember, which is reinvest in the business. They can pay down debt. They can carry it as cash on the balance sheet or return it to shareholders in the form of a dividend or share buybacks. Now, to find out if that dividend is indeed covered by the cash flow, by the free cash flow, we have to do a little bit of math, and we take $31.70, right? That is our free cash flow number. And then we're going to hop on over to the income statement, where we will see the dividend per share of $4.05. Now, just remember that number, 3170, because we're going to divide $4.05 by $31.70 free cash flow times 100, which is going to give us a free cash flow payout ratio of 12.77%. And check this out. If we go to Simply Safe Dividends, where a site like this is nice because they will have a lot of this already done for you. What did we say it was? 12.77% free cash flow payout ratio. And there we go, 13% for the last 12 months. They rounded up to 13%. So we see that is a very low number. And to get the warm and fuzzies, a lot of us in the community like to see 60% or below, gives us some wiggle room. And when you see things like 171%, time to get a little worried and hope that it comes down really, really quickly. And there it is again, your $31.70 of free cash flow per share. I mean, this video easily could have been 3 hours long, just going through every line item. There is so much to look at, but I really wanted to show you just some of the main things, the general concept, the general ideas. I hope I've done a good job. And if you would like to not do this and hit that easy button and go for something like SCHD, where you buy one ticker, you get just over 100 companies that grow their dividends really nicely. Here in the floating little box is my friend Ryan Williams, who did a video about SCHD. I'd highly recommend checking it out. And if you do that, he will tell you all about it there.